these other factors that show up in that plan is like when Social Security kicks in. Okay, that's going to impact how much I can convert to Roth in the later years. I've got to worry about my Irma tax, not that little lady in the corner, but Irma for the Medicare.
Starting your route to retirement.
Welcome to the Guided Retirement Show. I'm your host, Dean Barber. Today, we're going to talk more about tax planning. I've got Marty James of Marty James Investment and Tax Planning. It's going to be a great conversation. We're going to travel through tax planning techniques, not for the ultra wealthy, but just for the average American. And as you'll learn from Marty in this, tax planning is critical, but in order to have a proper tax plan, you need to have a financial plan done first. Before we hop on to today's episode, I will remind our listeners and viewers that you can access the same financial planning tool we use for our clients, all on your own time and all from the comfort of your own home. All you need to do is visit the link in the show notes, click the Start Planning button, and from there, you can start building your retirement plan, no cost, no obligation. Please enjoy my conversation with Marty James. All right, we've got Marty James. Well, actually, Marty James. He's the founder and owner of Marty James Investment and Tax Management. Marty, welcome to the program here. It's exciting to talk to you. So tell us a little bit about yourself so that our viewers and listeners can have an idea of who we're talking to here.
Well, thanks for having me. So I started the practice like in 1986. And have continued to grow. Since then, we have 9 employees now. We're a CPA firm, but we really focus on the tax planning and the wealth management and financial planning side of the business. The thing that we don't do is we don't do a lot of traditional CPA services. We don't do like audits, financial statements, and things like that. If the client needs that, we have other CPAs we can refer that out to. But our main focus is the tax planning and, trying to get people to keep as much as they can.
Yeah, Marty, one of the things that you and I both know is that as long as we live in the United States and we either have money or make money, taxes are going to be a fact of our lives. Tax planning isn't something that is, about saving money on taxes just in a given year. It's about creating a structure so that you can pay as little tax as possible over your lifetime. So let's start from the very beginning here, and I want to know that you're on the same page as I am, and if you're not, that's okay, but I believe that the only way that a person in your role as a CPA can actually do really good, effective, long-term tax planning is by first having a comprehensive financial plan done. Would you agree with that?
Yeah, I definitely agree with that, because one of the things, because people have, you're talking, the key word you said there was life and life, span. So the thing that you have to look at, no matter what tax planning you're doing, you need to know, what's their cash flow, what's it going to look like? Can they pull this off? And without that financial plan, you have to have that part done to see the cash flows and say, okay, yep, this could work. Then you dive into the tax plan to actually see, what can we do to make this better? And, it might start off where, typically you might do like a 10-year tax plan, especially for those people who are, trying to run them up to required minimum distribution age, see what it might look like. And then, of course, there's Social Security benefits. What are those going to look like? And then, start working from there. That's how you develop like your Roth conversion strategies, or whether I should be making Roth contributions, in my 401k or traditional, or a mix of the two. We're looking at a lot of different factors, but really starting out with that cash flow plan, the comprehensive financial plan, that identifies a lot of things, and where to start.
So Marty, let's get something out of the way right up front here. I think that a lot of people believe that tax planning is only for the ultra wealthy. I got to have millions of dollars in order for tax planning to really do anything for me. What's your opinion on that?
Oh, that is just so wrong. I mean, the people, I don't care who you are, there's something that can be done to make your situation better through tax planning.
All right. So if you've got somebody that's listening to us or watching us right now, and they've got $500,000 that they've saved, and they're, say 10 years or so out from retirement, you can help them, or tax planning can really help them create the right structure for the distribution strategy in retirement to help make sure that those distributions in retirement are as tax efficient as possible, so you're keeping more of your own money.
Correct. And when you think about it, the person who's like super wealthy compared to the person with the $500,000, that person with the $500,000 has a lower margin of error because of the dollars involved. So that's why it's even probably more important for those people.
Interesting point. Yeah, no, I love that. So, Marty, you talked about a couple of things in your tax planning. One of the things that you mentioned was Roth conversions, and the Roth IRA is absolutely my favorite investment vehicle from a tax perspective, because I think most people should know by now that the money that's in your Roth IRA is all yours. And as long as you've held that in there for at least 5 years and you've attained the age of 59 and a half, that money's all going to come out totally tax-free. And there are a lot of other benefits to that, but I don't think people really understand how to do a proper Roth conversion calculation. And I don't think that a CPA can do a proper Roth conversion test and find out whether or not that's the right thing to do unless they've already completed the plan, because there's so many other parts of the person's financial situation that are going to dictate how much money should be converted to Roth, if anything, and then when should it be converted.
Exactly, because I mean these other factors that show up in that plan is like when Social Security kicks in. Okay, that's going to impact how much I can convert to Roth in the later years. I've got to worry about my Irma tax, not that little old lady in the corner, but Irma for the Medicare.
So talk about, first of all, why the Roth IRA plays really well with Social Security.
Okay, so we have this concept called provisional income. All right, so determine how much of my Social Security benefits are going to be taxable. I'm going to take like all my income, plus even my tax exempt interest and such, come up with this thing called modified adjusted gross. So I'm going to use that 1/2 of my Social Security benefits, and if that number hits a certain level, depending on whether I'm single or married, then that determines whether I'm going to pay taxes on my Social Security benefits or not. So that's always kind of a game. So when I'm in that phase out up to that, so I can pay taxes on up to like 0 on it, or up to 50% of it, or 85%. So when I'm going from that 0 to that 50%, every dollar of additional income is really like $1.50. Or if I'm on up into that 85%, it's like $1.85. So what happens is when I take money out of my Roth account, it doesn't go into that provisional income calculation. And why doing the Roth conversions early, what that's going to do, that's going to reduce my future required minimum distributions out of my traditional IRA, which could actually have a big impact on how much taxes I'm paying on my Social Security.
And then,
as well as other things.
Right. And then I think some people play the game of maybe waiting too long to begin the Roth conversion, and they wait until they're on Medicare, and then the Irma thing that you mentioned a minute ago, that really comes into play. So the Irma tax is really, I'll see if I can explain this properly. It's going to tell you how much your Medicare premium is based on your total adjusted gross income. And so if you're doing big Roth conversion, it's making your adjusted gross income really big. So you're paying taxes on the conversion, and then you could also then cause your Medicare premiums to be higher, which is really just an additional tax.
Right. And if you look at the increases in the Medicare premiums, just at the base rate went from $148.50 to $170, something this year. So those are huge increases, and I think we can expect to see more of those. And who's to say that threshold is going to stay where it is? Maybe they cut it in half. So if I can get ahead of that game now, I need to be doing it. Even for some clients, it makes sense to maybe go ahead and bump all the way into an Irma year and pay Irma in 2 years, and then know I'm going to be in that lower rate forever by doing that larger Roth conversion. And if I time that large Roth conversion in the year that I retire, they have a form, it's a SS 44-44, where you can appeal that higher thing saying, hey, I had a change of situation, I had a reduction in work or reduction in income, or something like that, and possibly not have to pay it.
I've seen people actually be successful at doing that.
Yeah, we've done it quite a bit. The time, on when you're doing this, is really important. So, just sometimes it's best to do that last year when you're working, make that larger one. And you got to remember right now, we have these lower tax brackets. At the end of 2025, we go back to 2017 rates. So what is it, about 326,000 or so of taxable income is the top of the 24% bracket. Now that would throw me into that higher Irma thing, but I have a chance of actually beating that.
Right. So, Marty, when you're looking at doing a Roth conversion, what are some of the things that you're looking for to determine whether or not a Roth conversion makes sense for somebody?
Okay. Some of the things we look at, we don't want to like over Roth, especially for the people who are, charitably inclined, because we can do the QCDs, out of there. But when we're looking at, okay, you have the client who wants to give as much money to their kids as possible, effectively by paying that tax off in there, by doing that Roth conversion, you're making a gift to the kids without having to file a gift tax return. Plus, if you have a taxable estate potentially, again, we're scheduled to have these large exemptions get cut close to half, at the end of 2025. I've reduced my estate, also. So, those are some of the things, and really it's even like life expectancy. And one of the things, they always say on the Roth conversion is that you should pay the tax with after-tax money, or with money that you have outside of your IRA, so you get the most in your Roth. Well, that's true, but I've actually run numbers that if we're dealing with these tax brackets, and I'm already in my 60s, and I might be tapping some of my Roth money later as part of my cash flow, controlling my tax brackets later, I'm okay actually paying taxes out of the Roth conversion, just to take advantage of this tax arbitrage that we have right now.
You're one of the first CPAs.
Everybody's a little different.
Yeah, you're one of the first CPAs that I've ever heard say that. That's very, very rare. And by the way, I think that CPAs who actually do tax planning is very, very rare. So tell me why it is, Marty, that you believe that there are so few CPAs that actually do that long-term tax planning for people.
Yeah, because it's hard to have two different mindsets. You have the CPA who's into the compliance mode, tax compliance only. Then you have the CPA who is, in the planning mode. It's really hard to cross, the streams there. As a matter of fact, back in like 1984, I took a continuing education class from a guy by the name of Lewis Walker, and he said you can't do both. He said it just doesn't fit. And most CPAs, they like doing the compliance stuff. And I'd rather do the planning stuff.
Yeah. And I also think another reason, Marty, is that typically the CPA who's only doing compliance, it's not that they're not capable of doing the planning, but they don't have the information to do the planning. So they're going to see what was the W-2, what was the 1099 DIV, what was the 1099-R, what was the, rentals or royalties or whatever. They're going to see those things, but they don't really have the whole picture. All they know is what shows up on the tax return for the compliance. They don't know what does that person need. They don't know what's the asset allocation. They don't know what's the asset location. And so it's almost impossible for them to do anything other than ask a few questions. Did you do this last year? Did you do that last year? Well, maybe we can do a couple of things. And all they're doing is reporting on history, and at that point trying to maybe save a buck or two on last year's taxes. And to me, that's not tax planning. That's just basically compliance.
It's triage.
That's triage, right? We need to be understanding what that individual needs to live on and what their resources are. Are there going to be pensions? Is there going to be future inheritance dollars? In the money that's in their 401k, how much of it's in Roth 401k? How much of it's in traditional 401k? Another big one that I think gets missed all the time is NUA, or net unrealized appreciation, in 401k plans. And how do you treat that? And how do you put that into the plan for, when you retire? So talk a little bit about NUA here, because that to me is a big topic. It used to be more than what it is today, but there are still so many people out there that can benefit from the rules around NUA, or net unrealized appreciation.
Yeah. So just, to kind of help people here, basically what happens is in my plan, say I'm investing in the company stock, units that I work for. And so let's say that stock appreciates, say it goes up to $100 a share, and in the plan itself, they paid $25 a share for these. Okay.
Over time.
So yeah. So, at a triggering event, I can actually take that stock out. It is now in a brokerage account, okay, as a distribution, but I only pay ordinary income tax rates at that $25 a share and not the $100 a share. And then that difference then would be long-term capital gains once it's outside. It's a great way to get money out of the ordinary income tax world, which is always higher, into that capital gains rate situation. And so one of the things as far as getting ahead of that, the clients need to be educated that they've got this in their plan and here's what's going on, so that they don't get nervous and pull the trigger and sell the stock and then come back in and buy it again later and set up a new basis.
Right. And there's some limitations on that. It's got to be a publicly traded stock. It can't be a private company. And so what I would say is anybody that has a company where they have the option to buy company stock in their 401k plan, and that's a publicly traded company, they need to be looking at the NUA as a part of their distribution strategy in retirement, and they should really start doing that, I think, at least up to 10 years prior to retirement. What are your thoughts?
Absolutely. Absolutely. They need to know where they're at with that and know that, hey, I really don't want to touch that low basis stock in there, if I can avoid it, at all costs. Because where this could actually play in is for the client that's going to retire at 62, and they've got 3 years to 65 to hit the Medicare. Okay, so they may have to go to the marketplace to get their insurance. Well, if I can do this NUA thing in the year I retire before I actually get in the marketplace, now I might qualify for all the tax credits that they give me for having lower income, because now I've got this money out and it's liquid, and that's what I'm going to live on, which is also, you can also use Roth money to do that too, to bridge you to Medicare. I actually did an article on this, and I mean, effectively, if I'm going to retire at 62, it's possible because of that credit. Say I have to pay $20,000 a year for my health insurance when I could actually get it at $300 to $400 a month. That's like the highest tax bracket there is. It's higher than like 37%. So if I can plan ahead for that, and NUA would be one great tools to do that with. Yeah, I mean that, and you're right. 10 years is something they really need to be looking at.
Yeah, and I think I've seen so many cases, and you've probably run into the same thing. You started in this industry in 1986. I started in 1987, so we're pretty similar as far as our careers in this industry. But I've seen so many people that had that company stock in their 401k plan, and they'd play games with it. They'd sit and talk to their buddy, right? Okay, so if it hits this price, we're going to sell it, right? And then when it comes back down to this price, they're going to buy it back again. And so they totally blow any of the tax planning opportunities in there because they're trading that company stock inside the 401k plan, as opposed to just buying the shares over time. And most companies will split that up and they'll say, well, this block of shares has X cost basis, this block of share has a Y cost basis. So you could even go to that example that you gave of $25 per share as the cost basis on $100 stock. Well, some of that stock you may have paid $5 for. And you can do an NUA with part of it from most companies. It's not an all or none type of a thing. And that's such a little known thing that people that have the ability to have company stock in their 401k plan know about, but it's a huge tax planning tool. Yeah.
And it's one of the things that, as long as we're talking about the 401ks, it's amazing. You ask people, how much money do you have in there? They really don't know. They don't look at it. Then the other thing is, say, well, does your plan have these certain provisions? They don't know. And so we start talking about the SPD, the summary plan description. I say, let's get a copy of this and let's just dive into it and see what you have available in your 401k. What can you do?
So another tax planning tool, I think, if you go prior to retirement, we're talking about pre-retirement now. We'll get into maybe a little bit after people have retired and what kind of tax planning can go on during that time of a person's life. But one of the mistakes I think that people make all the time is they're not really paying attention to whether they should be contributing to the traditional 401k where it's pre-tax or whether they should be contributing to the Roth 401k. And there's not a black and white answer there. I think it's a depends on where you're at in your earnings level, what you think your income's going to look like in the first few years of retirement. So talk about what you do, Marty, in order to help people figure out should they be contributing to the Roth portion or the traditional portion of their 401k.
So one of the things that we're looking at is, again, you're circling all the way back around to that financial plan first, okay? So we see what their income's going to look like, and we can kind of target, here's, a lot of people think, well, I hit retirement, I'm going to be in a lower tax bracket. Maybe not, and
right.
More than likely not. So, we do that. We look at that and we say, okay, based on here's what we see happening. So let's look at our 401k and we look at their current tax bracket. Well, when we do our planning, we say, here's how many dollars. We have this marginal tax system. It's progressive. Okay. So not every dollar is taxed at 24% for me. Some of it is in the 22. So we do this, we say, okay, out of your income, here's how much is in the 24% bracket. Well, we don't think you're going to be there in the future. Maybe we do enough of our Roth contribution or traditional contribution to get those dollars of 24. We're not paying 20. We're going to get a current tax deduction for that or a current loan from the government on that. And the rest of it is we're going to be, at 22%. We're just going to maintain a 22% bracket all the way through. And, that also works for the person who's in the 12% bracket because that next move is up to 22. And again, but you have to be looking at what Social Security going to look like, required minimum distributions, and other factors. Is my wife going to outlive me?
So really, what you're saying then is you can't make the right decision on whether you should do Roth or traditional or a combination of the two until you've already looked into retirement and said, what are all the sources of income going to be? What are our assumptions there? And then you can come back and say, all right, this is where we're going to be in retirement. All right, let's back up now. Now we can make an actual educated decision on how much goes to Roth versus traditional.
Correct. And, a lot of plans now have what we call the Implant Conversion. Okay. So for a younger person, maybe they already figure out that, hey, I really want to make Roth contributions. Okay. That's really what I want to do because that's where I think it's going to be best for me in the long run. And it probably would be. But maybe they start the year off, they're making pre-tax contributions to their traditional 401k. And of course, the government's giving them a little larger check because they're loaning them the money to do this. And then let's say the market corrects, fairly decent. Well, I could do that conversion at that point. And so the government, say it was a $10,000 contribution, the government loaned me money based on that $10,000 contribution, but I'm converting it at say $8,000. So I get to keep a portion of that tax loan that they gave me forever. That's mine.
Yeah. Yeah. And I think the one that I think is one of the most obvious is people that get into their, early to mid 50s and all of a sudden they find themselves in their peak earning years. And if they've done a decent job of saving some money outside of their 401k in a normal brokerage trust or taxable account of some sort, and you can earmark that money that's already been taxed to spend in the first 5 or so years. So let's just assume we're dealing with somebody that's 55 years old and they're in their peak earning years and they've got enough money in their taxable account that they can live and not even spend all of that, say, in the first 5 years. And now maybe I'm in that upper, the 33% bracket or something like that, and I can defer pre-tax. And then all of a sudden I get into retirement, I'm living all this other money, and I'm converting up to the 22% rate for those first 5 years of retirement, getting a lot of money in a Roth IRA, but I get to win the tax game that way.
Yeah. Or here, let's take the person who's making moderate income, okay, and they inherit some money from a brokerage account, CDs or whatever from their parents, and it's sitting over in this account here, but they're not maxing out their 401ks. Well, why don't they go ahead and just max out that 401k, and then maybe it's all going to the Roth and live on this inheritance, build up the tax-free part of it, which the money in the qualified plan is much more protected, from creditors and everything else compared to the money that I've got sitting in an outside brokerage account.
Yeah, so
And
again, it's almost like a shell game that you have to be wise enough to know what to do, because you're really just shifting money from one type of a tax bucket to another type of a tax bucket. And the idea is, let's get as much money in that Roth bucket as we possibly can at the lowest tax bracket possible, so that, when it comes time to start pulling that money out of retirement, we don't have a partner in it.
right, exactly. Because, dollars are fungible, but tax attributes are not.
Right.
So that's, you just have to be aware of that. And literally, everyone thinks, well, I need to be doing a Roth. Well, every year, something could change. So maybe one year I do Roth, one year I'm doing traditional. It just might, whatever makes sense.
I think
it's really it's an awareness.
Yeah. There were some amazing opportunities back in 2020 for people to do Roth conversions when COVID-19 hit, and maybe they lost their job, or they were out of work for 6 months or 9 months or whatever, and they didn't have much income. Well, that would have been a perfect year to do a Roth conversion, because your income's lower. So you might even have been able to convert up to the top of the 22% bracket, or even the 12% bracket, and got a lot of money out of that tax deferred and got it into a tax-free or tax-free forever type of a bucket.
Oh, yeah. Yeah.
So let's switch gears to people that are retired, Marty. And I know that there's a lot we can talk about here, and there's no way we can cover everything that a person needs to be looking at from a tax planning perspective in the amount of time that we have together today. But the point that I want to make to everybody is that tax planning is critical, and it's not about preparing your tax return. It's about looking forward and making sure that you pay as little tax as possible over your lifetime. So I think one of the things that people should be doing as they're getting to retirement is really focusing on the three tax buckets: the tax deferred, the taxable, and the tax free. So let's talk about, once somebody's done that, if they've done a good job in diversifying from a tax perspective, in other words, they've got tax diversification, then how do you coach people on what's the best distribution strategy? How much from each bucket do I spend each year? And that's got to be something that is very, very dynamic, and it might change from year to year.
It is. But literally, the goal right there is really to smooth out that tax bracket is really what we're doing. We don't want these large spikes, so we're trying to smooth that out. And so whatever that mix is, as far as distribution between Roth, brokerage account, traditional, that's really, what you're trying to do, trying to smooth that out. And the person who's thought, well in advance, has the ability to do this. I love it.
Yeah, I ran into an individual here, and this has probably been 14 years ago, actually, where he had retired at 60, and he was now 62 when he came in to talk to me. And I told him about tax planning, and he had brought his tax return in, and he handed me his tax return. And he goes, I don't know how you can do any better than this. And well, his tax liability for the last 2 years was zero. And I said, that's interesting. I said, what are you living on? And he said, well, I'm living on the money that I have in my savings account. And I said, don't you have any IRA money? And he goes, yeah, I got about $1.5 million in my IRA. And I go, that's interesting. I said, so when your tax preparer told you that you could have converted, and these days it was $92,000 that he could have converted each of those 2 years and paid a total of $11,000 tax each year. I said, was there a reason you didn't do that? He goes, well, my CPA never talked to me about that. And I said, well, surely he at least told you that you could go up to your standard deduction and personal exemptions, and you could have gotten like $30-some thousand out of that 401k with zero tax. Surely he told you about that. And he's like, no, we didn't talk about that either. Okay, so that goes back to the whole tax planning issue. And this CPA had no idea that he even had money in an IRA, because nothing was coming out of the IRA to show up on the tax return. So that goes back to the whole thing where, unless the financial plan is done first, that CPA can't really do an effective job at helping him reduce taxes over the long term.
That's correct. I totally agree with that.
Yeah, I think it's fascinating. And, you being a CPA, we study with a good friend of ours, Ed Slott. Both of us have for a number of years. He calls himself a recovering CPA. Are you in that mode too, Marty? Or are you really full on CPA?
I'm still full on CPA. Ed, his focus is IRAs only. And I just suck some knowledge out of him. Any chance I get. But then we have to have such a broad swath of everything we have to look at. because some of the stuff that's out here, you have people who know things and you have people who don't know things, and if you know these things, then it can tie right back into that IRA retirement plan strategies, and that's why we do have a pretty broad knowledge. And if there's something I don't know, I know people around the country who'll know if I don't know.
Yeah. So Marty, let's go to the possibility of investing in tax-free municipal bonds. And without getting into detail, we don't want to. This obviously isn't a recommendation on investments, but a lot of times people will say, "Well, I don't want to pay any tax, so I want those tax-free bonds." And how do you look at a tax-free bond versus a taxable bond, and how do you determine whether or not the tax-free bond actually makes sense, or does it make sense to use the taxable bond?
So again, that's really a tax bracket strategy where you're actually looking at equivalent yield calculation.
But don't you also have to factor in what's that taxable interest going to do to Social Security? What's that taxable interest going to do to Irma?
Exactly. So you look at the taxable, versus the municipal. The municipal bond interest, they're both taxed the same as far as your Irma and your
Social Security, but
Social Security, yeah.
But it's typically a lower amount of interest on a muni than it is on a traditional bond. Exactly. So you can't just do the arbitrage.
You could actually reallocate that. You would have to factor those things in when you're figuring the tax rate that you're actually using.
Right, because that taxable bond, you might say, well, I'm in the 22% bracket, but if you're in the 22% bracket and all that taxable interest is so much more that it's causing more Social Security to become taxable, causing the Irma, tax to go up, it could actually be a higher tax than that 22%.
Yeah. And on top of that, go ahead and let's throw the NIT on there, the net investment income tax, an extra 3.8%.
Right. We call that the Obamacare tax.
Right. Yeah.
Got to pay for that somehow, right? That's where the subsidies come from. That's where the subsidies come from. So with the tax codes changing the way that they are, how critical is it that a individual sit down with their CPA and their financial planner on at least an annual basis, and probably more importantly, maybe on a twice per year basis to discuss their overall strategy?
Yeah, I think that's really important, especially if you've got a transaction getting ready to happen or whatever. That should be an automatic. But definitely, at least once a year. So like in our office, what happens is, as the return's being finished for the prior year, I'm picking up the phone, calling the person, saying, okay, what do we got going on this year? Anything different? And kind of doing a little bit of pre-planning right there, early in the year, as opposed to waiting to the end of the year. So what we might have already done is made our Roth conversion amount calculation, what we're going to do, even though we may not do it till later in the year. But if we get an opportunity, mid-year to actually do it, we may do like part of it, but not all of it, just because we don't know, the prize patrol may show up at the end of the year, or they have a scratch-off lottery ticket or something like that, and we would wish we hadn't done it that year.
One of the things that I think is a mistake that I see happening often, and you probably don't see it happening in your practice as often as some other CPAs, but people come in and they'll bring in a tax return or all their information, and they wanted to buy a new car and they didn't want to take out a loan, and so they took $75,000 out of the Roth IRA, or not their Roth, their traditional IRA to go buy that car. And you're like, why didn't you call me and ask me where was the best place to get this money, right? Because they don't think about it. It's just money, and I'm gonna go buy whatever I want.
Exactly, because of that situation, maybe we would have just kind of done a little bit of the tax, the bracket bumping thing, and say let's go ahead and finance part of it, like over 2 years, or across 2 years, rather than having and say the person's in a 22% bracket, but then this would push them up to 24, or say it's worse, say it's 12 into the 22, where you got a much higher. And if we blend this out, sure, you're paying a little bit of interest, but the tax savings is going to offset that.
Yeah.
By far.
Yeah. So I think part of tax planning needs to be, if you're thinking of making a major purchase, if you're going to buy a second home, if you're going to buy a vehicle, anything that's a major purchase that's outside the norm of your normal budget, especially in retirement, call your financial advisor, get them in the same room with your CPA, and talk about what you're trying to do, and then let them come up with the best way to get the money that you need so that you'll pay as little tax as possible on it.
Right. And one of the things, you really need to do that tax projection at that time you're getting ready to do it, because you need to figure out what what kind of withholding should I have on this? And, can I, so we have a market that's down right now. So maybe I won't, and I think it's going to recover, let's say. So maybe I just take out, what I need now, and then later take a distribution out to pay for the taxes. Or I figure myself that I'm actually on a safe basis for penalty purposes, and I take the distribution out to pay the taxes in the following year. Those are some of the things that you do before you take the money out. Figure out, because really the withholding part of it, I see that missed a lot. The person says, "Hey, I need $75,000." There goes a $75,000 check, and there was no withholding.
Yeah. Well, and Marty, that we have a team of CPAs here in our office, and to me, that's one of the most critical things is before you make that major purchase, or before you decide to do something, before you decide to give some money to the kids or give some money to the grandkids, let's look at that from not just the perspective of where do we get the money. You got to think about the tax impact, not just in this year, but in the next 5 to 10 years. How's that going to play out in your overall plan?
Exactly.
It's really all about keeping those lines of communication open and knowing that your financial advisor, along with your CPA, are your trusted advisors, and they're there to help you. Because one of the things I know is when people come into us for the first time and we start working for them, it's probably the same with you, is that most of the time people are overpaying their taxes and they don't even know they're overpaying their taxes. And it's not because their tax return has been prepared improperly. It's because they missed opportunities in those years, like the story I told you about a few minutes ago here.
Right. Yeah. Yeah. I hate that conversation. Actually, when the person comes in, you look at it and I go, "You've been wasting $60,000 or $70,000 a year of your tax bracket."
Yeah.
And then when you show it to them, what's going to happen, in the future. I hate that conversation.
Well, but so the point is, I think that let's go back to what we talked about at the very beginning. Tax planning is not just for the ultra wealthy; it's for everybody. And the people that have the less money have a smaller margin of error, like you said. So it's critical that people engage with a financial planner and a CPA to make sure that they're getting it all done right.
Exactly.
Well, Marty, I appreciate you taking time. I know that we're after tax season here. You look like you're well recovered. Great to see you.
Yep. All right, same here. Thanks for having me.
I hope you enjoyed my conversation with Marty James. There's so much to learn when it comes to creating a proper tax plan. And as Marty said, in order to have the tax plan done, you have to have the financial plan done first. Don't forget, we're offering you access to the same financial planning tool we use for our very own clients. Just click the link in the show notes, click the Start Planning button, and begin your retirement plan from the comfort of your own home.
Starting your route to retirement.
Thanks for watching. You can subscribe here to get the latest from the show. Also, be sure to leave a comment and share this with your friends.